Thank you. So this is work with Pascal Saint-Amour in Lausanne. So the outlook for Canadians, Canadian retirees has changed a lot over recent decades. You see similar patterns in other countries. People are expected to live longer once they reach sort of the normal retirement age. They've accumulated typically more wealth, in particular in the form of housing. And there's a trend that started in the US, but observed in many other countries, of employer pension plans transitioning from defined benefit to defined contribution. What that means is that potentially there's a lot more risk to deal with in retirement when thinking about how you decumulate saving. A lot of work has been done on accumulation over the years, quite a bit also on decumulation, but maybe a little bit less, so this is the topic of this paper. So what's the problem households face is that figuring out how to decumulate saving is a very hard problem. Among many other things, time of death is uncertain, so if you have no bequest motive and you were just trying to think how to decumulate financial wealth, that would be a fairly easy problem, and you would end up with nothing at the time of your death. And obviously timing of death, which is uncertain, introduces longevity risk, but also from a more behavioral perspective, also the risk in terms of households thinking, if I don't decumulate fast enough my wealth, I'm going to end up with a lot of wealth, which I won't use. Housing and medical risk are quite important. In the case of Canada, it's much less the sort of traditional medical risk, but it's more long-term care risk, which is potentially important. Household composition complicates a lot the problem. It's not only a matter of your own situation, but very often of your spouse situation as well. And of course, you might want to leave as well money for the kids, so there's and potentially the role of how much you want to share resources with the next generation. This makes the problem even harder. There's a large literature on insurance. I'm not going to spend time here on that, but how do you insure against those risks? Of course, you can self-insure. You can buy annuities, which protect you a lot against longevity risk. You can buy long-term care insurance, which protects you against these long-term care, for example, expenses you might face. And there's reverse mortgages, which allow you to insure against a number of these things by simply extracting home equity and then using it to finance consumption in old age. What we found for Canada in a series of papers that we've done over the years, very often using experiments, is that first of all, if we look at the take-up in Canada of these sort of risk management products, we find very low numbers. So for example, for annuities, about a 12% take-up of annuities among near retirees, long-term care insurance very low, reverse mortgages even lower. Intentions, once we do these experiments with hypothetical choice situations, sometimes we do get slightly higher intentions. There's a lot of potentially supply factors there or informational barriers that once you do experiments, people are sort of, once they're primed about all these considerations, they seem to be much more interested in some of these things, in particular for long-term care insurance. But the main problem in this literature generally is that we have quite a bit of info that take-up is low, but when I say low, we don't know what the benchmark, what we should be comparing it to. So should everyone buy these things or not? Who should buy them? So there's been a lot of work, but much less at the individual level trying to think who should actually buy these things, whether they want to buy it or not, and that explains this heterogeneity. So this paper is quite different from the traditional literature on decumulation, where typically you use longitudinal data on observed choices, both wealth accumulation, saving, insurance take-up, and you sort of estimate a model of that and then try to back out like what are the main reasons why people don't buy it. And the main reason we're going to deviate from this is that from previous work, we see that there's a lot of information barriers people face, and in particular supply constraints, where a lot of people are not even aware that these things exist. And so when we use observational data to infer demand, we have this problem that actually a lot of these people that we're inferring are not buying it, right, from a preference considerations, are actually not buying them because simply they haven't been made aware of it or there hasn't been enough information shared. So we're going to be trying to use an experiment, what we call a stated preference experiment, for all of these products together in the same sort of experiment, both for long-term care insurance, reverse mortgages, and annuities. And we're going to be varying a lot of the characteristics of these products in a random fashion so that we have some relatively nice variation to try and elicit preferences for these things. Another novelty of this paper is rather than simply doing an experiment and estimating reduced form demand curves, is we're actually going to try to do the ambitious thing of estimating from these data an underlying optimal choice model, a stochastic life cycle model, that will be tailored to custom fit each of these respondent situations. So there's going to be a lot of heterogeneity in the model to allow to tailor it to each households. Obviously, because households are probably not solving or not directly solving that model, we're going to embed that model into a stylized or relatively simple for now behavioral response mapping, meaning the mapping between what people are going to tell us they want to buy in the experiment and the underlying stochastic life cycle model. We're going to try and build a mapping between these two things that will allow us to filter out some of these potentially behavioral considerations from responding to hypothetical choice situation. Once we've estimated the model, one of the nice advantages is that we can contrast both the responses that respondents gave us with what the model would have implied for them in terms of what could have been their optimal choice, defined in a very strict way using the model. And so we're going to then investigate or do a quantitative analysis of the different motives to purchase these products. And finally, as a sort of bonus of tackling all three products together, we're going to be able, it's one of the first papers, there's a few papers out there, but one of the first papers to actually investigate the demand for bundling, so considering these products jointly and seeing, using the model, whether there's actually demand for that. Okay, so the very relatively stylized description. Yeah.
Just to clarify, the difference you showed at the beginning between intention and actual take-up is very different across products. It's something that you're going to be interested in looking and it could be so when you think about bundling, this could also be
so that's going to be actually quite interesting to look at it. So these intentions that I showed are very similar to these experiments we run here. This is sort of the natural follow-up to what we're doing, but we're going to exclude in everything we're going to do, we're going to exclude people that actually bought these things. We're really interested, since there's so few, and in a survey like this you don't get that many, we're going to be interested in all the others, right, that didn't buy it, and what's the demand, what's their demand for these things.
But the difference between stated intention and actual, are you going to look into that?
No, because in previous papers we've shown that part of the difference is really a lot related to supply side considerations. Yeah, so we're not in this paper, but we sort of have a story for that part of the difference. So households here, I'm going to go relatively quickly over the model. So these are going to be potentially couples when we have couples in the data. There's very few papers that do that in the literature. We're going to try to think of them from the point you reach retirement, if that helps you think of 0 as age 65, but of course we're going to tailor this to each respondent. And households are going to be IJ when they're couples, and when they're singles, they're I. One of the key elements of the model is obviously the risk. So the health state is going to evolve across 4 states, so good health. Some difficulties in activities of daily living, but that do not require to move to a nursing home. So, you can think of this as very limited limitations. Big L is actually imported limitation that forces you to go to a nursing home and be dead. So there's 4 states. Couples are going to be transitioning over 16 states. And one of the nice things is that these beliefs are both sort of the objective risks that we could predict for each household are going to be individual specific function of their health, but also we're going to allow for potentially their own beliefs about their mortality risk and their health risk to be different from those. We'll do something similar for house price dynamics in the model. So housing is going to be a key important. So there's going to be, if you want, the objective or the sort of the process that everyone would use in a model like this, which will be a random walk, census, metropolitan area specific. But again, it will have these heterogeneous beliefs. So it'll be eliciting how people think about future house price increases, and you'll see how we do that. And we're going to be able to flip these things on and off to see their role in what we're doing. The medical costs obviously are going to be a function of these health state. Households are going to have faced a relatively rich budget constraint. They're going to have initial financial wealth. They're all going to be homeowners in the survey with the current value of their house. They potentially have a mortgage. They potentially receive annuity income. And they can borrow either using credit card if they're a renter or HELOCs, like home equity line of credits if they're homeowners. Of course, the key element to map it to the survey responses is going to be to have an initial choice of whether or not you want to purchase protection against longevity risk, annuities, disability risk, long-term care insurance, and reverse mortgages. And households are going to be Epstein-Zine utility maximizers, and we'll have warm glow bequest motive. So just a few moments to think about the timing. So when people are going to be answering the survey, we're going to assume that they're thinking about whether or not to purchase the products we're going to be offering them. But they're going to be taking into account that buying these products will likely affect their plan in terms of how long they're going to stay in their house and so on. So there's going to be a housing choice. And we'll allow people to actually sell their house, potentially rebuy one in the future. And a consumption plan that they're going to be picking conditional on choosing a particular product. So this does not assume that their consumption plan or housing plan is independent of whether or not they purchase the product. Everything is sort of going to be taken into account here. Yes?
I don't want to make a complicated model more complicated, but it's divorce risk. That seems to be something that for you own a house.
No, so the only risk to be taken apart is death of the spouse. So there's no divorce risk.
The possibility to take care at home in some form.
I mean, these are going to be people in their 60s, almost 70s. So I don't think that conditional on being married at 65, there's that much divorce, at least in Canada. I should have that number, but my hunch is that's going to be negligible. But
retirement seems to be a shock in many cases.
Yeah. No, you're right. So I should have the number to actually answer that question. Okay, so one of the key elements in the model to keep it solvable for agents is that so this is home equity in some sense. These HT is whether you own a house. This is the current value of your house. This is your mortgage. The mortgage is not going to be a choice in the model. That's important to at least tell you in the presentation. So there's going to be some assumptions made on how mortgages decrease over time as people repay. There's not going to be an option to refinance or prepay and so on. So we can't allow for that. This would be too much for that model. Perhaps a point to defend this is that mortgages are generally small at these ages. So potentially it is interesting or important, but we cannot deal with this here in the survey. So almost the last slide on the model, because I can't go in all these details, otherwise I will not cover this in 40 minutes. So the budget constraint, both households have income, which will be elicited in the survey, and they're going to be giving us both their current income, but also their expected income in retirement, and then so we'll take that into account in terms of what they're thinking about income, but you can think of this as relatively fixed. Conditional on household status. Obviously, households that have two members are going to have more income than households with one member or one slot size. In the budget constraint, there's this very important variable Z, which is going to capture all the net flows from purchasing products. So in the first period when people buy things, obviously if they buy an annuity, there's going to be a big negative flow because they're taking some of their wealth to actually buy the annuity. If it's long-term care insurance, every period they're going to be paying the premium when they're healthy, and then when they become unhealthy, they're going to receive some benefits. So Z sort of clears out all these things in terms of these different products. For a reverse mortgage, they'll be extracting home equity, and you'll see a plus here on this DT variable, meaning like they're adding more resources now, and upon that they'll have to repay that loan. There's a consumption floor or resource floor, which is a standard way in these models to take account of all these complicated means testing support programs in a very simple way. So we do that. And finally, as I said, borrowing is important to allow for when we have reverse mortgages, because reverse mortgages is actually a way of borrowing. So you do want also to contrast it in particular with ELOCs, home equity lines of credits, which have some differences, but in some sense are a substitute for reverse mortgages. So we allow for that in the model. This is my usual intimidation slide in terms of just the problem. So this is an Epstein-Zine
That's the reverse of the preservation age, right?
Yeah. Of the Bellman equation, the Epstein-Zine Bellman equation. The key thing is epsilon, which is an inverse of the intertemporal elasticity of substitution. Gamma is the coefficient of relative risk aversion in that model. There's expectations over home prices over these complex health transition probabilities. Key thing is the intra-period utility function. So it is CES in consumption and housing. This is the housing flow to utility. And there is the shifter, which is very important in what we do. So this new here in front, which actually is going to be a function of the health of spouses. So we allow, for example, the marginal utility of consumption to decrease when you're in poor health, or could increase in principle also. And T is the number of household members, the equivalent scale for household members. And bequest motives in the Epstein-Zine formulation take the following form with some P parameter in front. So to summarize what the respondent picks, if he was fully using that kind of model and doing sort of the calculation, he'd be solving this backward from the time, let's say, maximum age that someone could live for, which is, I think, 110, if I remember correctly, and just going backwards all the way to his current age. And what is he doing at each of these periods, from death through the first period? He's choosing a state contingent consumption plan, a decision rule for when to sell or buy the house in the future. And in the first period, he's choosing whether or not to buy insurance, and then we're going to offer him products that he could purchase. Okay, so the experiment. So we in principle aim to estimate this model on experimental data. And so what we picked in May, it seems like a long time in the past, given everything that's happened. In May 2019, we surveyed respondents 60 to 70 in 11 major CMAs in Canada. We focused on people in CMAs because we were very interested in this house price mechanism, and in particular the potential desire to extract home equity for these CMAs where potentially house values had increased a lot. In retrospect, one of the downside of doing this and the fact that we're conditioned on home ownership is that we have a very hard time trying to match these data to actually observational data from Statistics Canada, because we don't have longitudinal data where we could say, well, what does an 80-year-old typically have in terms of wealth if he was a homeowner in one of these CMAs at age 65? So we don't have an HRS in Canada, so that obviously makes this very interesting and very maps well with the model, but in another sense imputes our possibility to actually go and look at the data what these guys are actually doing at older ages. So in total, we have 1,581 households. It's a complex process to which we lose people, both because the renters, initial renters, at first we wanted to include the initial renters in the model. We realized later that we could not. We don't really have any clue what sort of house they could buy in the future, house value that they would consider. So we're conditioning on homeowners. About 2/3 of those are couples, 1/3 is single. And as for those who have run surveys, obviously, given you're going to be putting a model onto this, there's a lot of actually observations you lose just from looking at the responses and finding that they'd be a lot of trouble for the model, just probably because there's a lot of reporting or measurement error. So we end up with this group of people. So importantly, I'm going to spend a bit of time on this. We're going to take these people, we're going to ask them a bunch of background questions to start with. And then we're going to start presenting them with 4 scenarios for each product. So 4 annuity products, 4 long-term care insurance products, and 4 reverse mortgages. And we're going to be randomizing a lot of the features of these products. So to give you an example, for annuities, this is sort of a transcription of the intro screen. We tell them a little bit what an annuity is. There's a premium, there's a benefit, and then afterwards we present them with the actual parameters. We index to inflation, which back in 2019 was not really an issue. No one cared about that. And now I'm getting all sorts of questions when I present this about what you mean by indexing and what about house prices and what about this. So at that time, this seemed like a good idea. We present them, basically, we use their initial financial wealth that they reported in the survey, and then we present scenarios in terms of them annuitizing 20% of that wealth or 50%. So they're going to get 2 scenarios of each. And then for the premium that we're going to be using, or if you want the yield, we're going to be using yields that are coming from quotes of insurers offering these products by age and sex. And so those are the yields we'll be using. And we're going to be randomly, so take the yield and think of it as either the fair price or the market price. And we're just going to be randomizing that, shuffling that yield around with a factor where we're going to basically vary this from 0.5 to 1.5. And so people are going to get 4 scenarios in total, 2 with high benefits, 2 with low, but there's going to be variation in terms of the relative price of things that they're getting. So there's variation both in the quantity here as well as in the price. We do something very similar for long-term care insurance and reverse mortgages. I won't show those. And then basically the question and the way we ask question is important here is that instead of asking for a choice, forcing a choice, we're going to asking people what are the chances that if you were offered one of these things, you would take it. There's a little bit of debate in the literature as to whether that's a good thing or not of asking a choice probability. One of the advantages is that you have now a measure, a little bit of the intensity of preferences. You have a bit more information than just a 0-1. Minsky also argues that in some sense, this is not a natural choice. There's a lot of things that are unspecified here, so maybe actually allowing people to report a probability is more natural. But then there's other folks that say, well, people have trouble reporting probabilities and so on. And so we're going to be here using this and exploiting this to the fullest when estimating the model. We'll see how it comes in. So in terms of the levels of intentions, that's links a little bit. We're not getting exactly the same thing. It's not the same sample. These are homeowners, 60 to 70. But you see about 10% on average. So on average, the probability of buying is about 10, 11% for annuities, 17 for long-term care insurance, 7 for reverse mortgages. Quite a lot of zeros in all scenarios. So these are folks that are just like against buying any of these things. They're probably not looking much at them. So when I talk of a behavioral mapping of the model to the responses, I'm going to have a parameter that will capture a lot of that. And we'll look at a little bit at the properties of these behavioral parameters. And finally, just some statistics on who knows the product. You see that before they start the experiment, actually very few people know these things or know how they work or have some basic knowledge. Reduced form within price elasticity is just to see that actually people are paying attention to what's going on here. So negative price elasticities that are estimated from within regressions for each product, so with fixed effects, and the same for the quantity or the benefit that they're getting, positive elasticity, statistically significant everywhere. I'm not reporting
Pierre-Carl, just before we move on.
I'm sorry?
Sorry, could I just ask a quick question?
Yeah, sure.
Did you get, when you looked at these initial data, did you get any sense that people understood the alternative health risk implied by choosing annuities versus long-term care insurance? So were they negatively correlated with those choices, for example? What did the joint?
That's actually interesting. So just the reduced form without a model. So you see that we spent a lot of time on the model, and we should have looked at that. So that would be interesting, just to look at the reduced form correlations between these. We did not look at that. Okay. Of course, implicitly, it's going to be used in the estimation, but it's not being, we're not seeing it.
Yeah, but I mean, one of the things you have to always have to worry about is that there are stop-loss arrangements from governments in the background, and that might affect things. That's part of it.
Sure.
No, but
It's hard to get it.
There's no joint presentation of this.
No, so we should add this to this table.
But then the question is, as people are answering it, they're living in their real world.
Yeah.
They know there are stop-loss, what they're calling it.
Yeah. But we should just look at what's the fraction of people who actually have a positive probability for all three products, that kind of statistics. Okay, good question. Okay, so real quickly on two innovations of the model, and since I'll be presenting in the end the results, I'll be focusing on those. It's important that I tackle these. So remember, we have these transition probabilities across health states, and we want to make them individual specific. So in the survey, when we designed it, we did ask people for a battery of questions on the current health conditions they might have, their education level, obviously, a lot of other variables that are typically input into trying to predict the future health of someone. And we feeded that in a model that we had built here at the Institute a long time ago, which was used also in the Pierre-Carl paper. And basically, I don't have much time to spend on it. I think of this as a model of actuaries, just trying to take inputs and just forecasting the risk for each individual. And so we actually have for each individual in a couple, in all the sample, we do have an individual specific set of transition probabilities over time that are coming from that model. So someone who has initially diabetes and other health conditions is facing higher risk of, in the future, being disabled and probably dying younger. So we've used that in other papers, so that's not necessarily the novelty. So when we're going to be solving the dynamic programming model, each of these couples is going to have individual specific health risk. But what we had to this is that we did ask about the subjective probability of surviving to 85, and we're going to exploit that to sort of fit an additional parameter in the health process. So this individual specific health process is going to look like this. So you see eyes everywhere, meaning that all the parameters are individual specific across health states. But the ones for transitions to death are going to have this additional scalar here. And this scalar is going to be chosen so to match the subjective probability that people are telling us. So we're going to have these potentially, and I don't want to say erroneous, that's actually a dangerous term. Could be that people have private information about when they're going to die, but those subjective beliefs are here in the model. But yes?
In the model, you would like to have the subjective probability of all the states, right?
Yeah, so that we did have ambitious questions trying to see how we do that, and in the end it's extremely hard to try and map them to the...
But let me rephrase the question, is it,
It's doable.
No, but what would be the added value in the model to have subjective?
Oh, it would be nice to have the heterogeneous beliefs in terms of these other states as well.
Maybe you're already fitting well the data without that, so...
Yeah. So one nice result I want to emphasize. So first of all, in Canada, when you ask people around 60 to 70, they're actually quite optimistic about their survival prospects, which is very interesting. And does not necessarily, when we compare across countries, lots of countries you actually do see pessimism at those ages for surviving to 85. But what I want to spend time on, which is interesting, is this is the correlation in the probability of surviving to 85, so the joint distribution for respondent and spouse, for those in couples, using this objective model. I call it objective in a loose way, but this model, you can think of it as the actual model. And there's a positive correlation, but it's not as strong, especially not as strong as the correlation in these psi parameters here that you see. These were, remember, these beliefs they have about how long they're going to live. So someone with a positive here is very pessimistic, thinks he's more likely to die young, and the other way around. Now we're asking only the respondent about his own survival, but also his spouse survival. So it's normal we'd expect some correlation because it's his own expectations, but this is actually very relevant because when we make choices about these things, sometimes we make them talking to our spouse, but sometimes we do make them on our own thinking, how long do I think my spouse is going to live? And so very strong positive correlation in terms of these deviations from objective risk. House price risk, so I'm not going to spend time here, so we estimate a random walk process, CMA specific. It's not rejected from the data for most CMAs. What's interesting, and here don't look at the econometrics, actually I shouldn't even show that slide. So, but one of the nice novelty in the paper is we ask people for the probability that in 10 years, prices will have either decreased, and then afterwards we ask them, what's the probability you think they would increase by more than 10%? What's the probability you think they would increase by more than 20, then 30? And in this way, you're basically getting a distribution of their subjective beliefs. And so what we do then is we use that to actually take the random walk process, which is CMA specific. So we know if it's random walk, the average growth in t years is simply t times the drift term. The standard deviation is square root of t times the standard deviation of the CMA process. And we're going to tag on that a mu I and this parameter here I, which allow us to estimate basically people's deviations from both what's expected in terms of average growth, but also the volatility of house prices. And so we do that through a minimum distance estimator and get those beliefs. This is what they look like. So basically, people are generally pessimistic about house price growth at that point in time relative to these CMA-specific random walk processes. Not necessarily that they're wrong or right. We don't really know, right? But they're certainly more pessimistic. But there are also things that there's much less volatility. So one would be exactly what's predicted from the random walk process. So they're expecting much less volatility in house prices than there is actually in those processes. So that's going to potentially have a big impact on the decisions. Okay. So I'm going to skip preference shifter. So we use observable answers to questions we ask to actually allow for preference types in the model. And so let me spend a few minutes on estimation and then focus on the key results. So this, I think, is the main interesting part of the paper. So what we have is we have a set of N respondents. They faced a tuple of potential price for annuities, long-term care insurance, reverse mortgages, and a benefit. So you can think of each of these scenarios K as presenting a different, potentially, budget constraint. And respondents report a probability PIK for each of these products. And then obviously there's always a benchmark case. They're always comparing the utility they're going to get buying the product to a case where actually they're not purchasing any of these things and they're continuing in their current situation. So think of this as the utility sum, that you solve from the complex stochastic life cycle model for product K. The utility gain from purchasing product K is simply the difference relative to the baseline situation. And so this is the experience utility of purchasing the product. Now the decision utility, we allow for, first of all, I call it a default bias or status quo bias that potentially is individual specific and product type specific, where households used to remember this fraction of people who never purchase the product. So we want to capture this with this. And an idiosyncratic, you can think of this as a trembling hand type effect that gets added to the decision. And you purchase the product, if that whole thing is greater than zero, then simply this greater than zero. Now, if you put a logistic assumption on this, you end up with this mapping to the observable choice probability. You get a logit probability, and you see now this parameter appeared in front of the utility differences. And if it's zero, it means that basically there's so much noise in what people are making as decisions that this V has no impact on their reported probability. And if it's different from zero, then that tells you that there's quite a bit of signal, so much less noise here. Yes?
So the questions you ask people about their chance of purchasing the product appear in random, is that right?
The probability is here.
Oh,
that's the reported probability, and we're trying to map it to this.
And then they
Yeah. So what we do is we transform these reported probabilities with a log odds transformation. So this is still observable. We now get a nice linear equation, so we can eliminate these things, these fixed effects. So now we're exploiting only the within variation across individual and product types. And this parameter, we don't need actually to estimate it jointly with these complex parameters that are inside the stochastic life cycle model, simply because we have a linear relationship between these two things. So a fixed effect regression for giving values of these give us estimates of this. So once for any trial value of theta, we estimate the value of this thing here, and then we estimate the remaining part by a very simple estimator, the nonlinear least square estimator, to estimate the thetas. I say simple, of course, as a joke, because for each trial value of theta, there are 1,600 couples that answer 12 scenarios, so you end up solving that DP problem a lot at each iteration. These are the estimates. I'm not going to spend time on the estimates and rather focus on what's different from existing literature. So risk aversion, we get something that is much lower than estimates coming from studies that use observational data. Our estimates are actually much closer to experimental evidence on relative risk aversion that you find out there. So both our own, Boyer et al., we report a value of 0.41. And Anderson and co-authors that are here report values, depending on the paper, that are typically below 1. So that's sort of where we stand. So we're going to have much less risk aversion in terms of what we're going to get in scenarios. And then the intertemporal elasticity of substitution is actually very large compared to other studies. So people are much more sensitive to things. And there is actually some studies, we did not cherry pick, we did try in the paper to look at a lot of different range of studies, but there are studies where the EIS is much bigger than 1. So people are going to be very sensitive to things, but not really risk averse. And for other parameters, things are much closer to what we see in the literature. Okay, so here's the bottom. So if I had only, and I don't have that many minutes, so this is one of the key tables. You work all that time to produce a table like that. So this is what we have in the data in terms of average choice probabilities. Once we estimate and account for these default biases and these noise parameters, we end up matching pretty well what we get in the data. Obviously, a lot of the work is done, let me be transparent, a lot of the work is in part done by the fixed effects. So that's like explaining something away with something else that you don't understand necessarily super well. But it does give you that mapping. Now, once you take out these things, you take out the behavioral mapping variables, and you just, when I call model base, it just means you purchase the product if the delta V, if the change in expected utility is positive. Then you get actually model-based estimates of optimal demand, which are much smaller than 0.5. Okay, so meaning that it's not that everyone or each of these individuals should buy the product. Actually, not even a third of them should buy these things. So when reinterpreting the gap between data, say in model base, allows you to sort of make various inferences. Okay, so let me just talk briefly about these scenarios where we try to understand what's going on here. So when we think of this optimal take-up over the scenarios we presented, so some of these effects, so here I sort of rank different effects in terms of how much they shift things around. So when we do not allow the marginal utility of consumption to decline with health, basically, in particular for long-term care insurance, we get almost a 6 percentage point increase in demand. And that makes sense if the insurance you're buying is paying you in a state of the world where you don't care about consumption. That should lower demand. So when we take that away, it increases demand. For survival expectations, so people, as I said, are quite pessimistic about in terms of survival. So they're expecting to die much younger. So when you make them at these pricing, they're more optimistic, then when you take out this potential bias or this deviation, you actually find lower demand, so not higher demand. So this can't explain why optimally the fraction that should purchase these things is actually low. When you think of house price expectations, what's very interesting is what's happening on the reverse mortgages. So these people are expecting low growth in house prices, which is actually a good thing in terms of thinking of buying a reverse mortgage, because there's a lot more chances that when you die, the value of the loan is higher than the value of your house, which a reverse mortgage protects you against. So when you take out this, and now people expect a sort of historical drift, then suddenly demand for reverse mortgages decreases substantially. Now the opposite occurs if you assume constant prices. So if you take out uncertainty in house prices and prices are fixed, this is sort of a gaming exercise. Taking out a reverse mortgage, a substantial one, ensures you that eventually, potentially, the loan value could be bigger than the value of your house, and you can just walk out, and there's no liability to your heirs or anything. So then demand would increase a lot. So it seems like house prices are super important, or the beliefs about house prices are super important for reverse mortgage demand. The bequest motive, interestingly, doesn't move things a lot. So we estimate in the model a very weak bequest motive. So that does not seem to be the reason why these people are not demanding these products. Okay, so just one, so I'm done almost. So one thing on reverse mortgage pricing. So this is the premium that you should charge on a reverse mortgage relative to a HELOC, home equity line of credit. Usually it covers the risk for the bank of the value of the loan being bigger than the house value. And in fact, using the scenarios which come from existing products, basically there should not be, in terms of actual pricing, there should not be any premium on a reverse mortgage relative to a HELOC. So anything higher than that is not valued by these consumers. Let me skip that and just finish with bundling. So we did consider the possibility of people freely buying any of these products at fair prices. And one of the interesting things, so in terms of total take-up, you see that when you allow them to buy it independently, not considering the possibility of buying the others, demand for annuities is only 5.5% at fair prices. When you allow them to buy it jointly, it jumps up. And the key effect actually that we see happening is actually people bundling reverse mortgages with annuities. So that's the main thing that they would demand. So basically, if you're liquidity constrained to buy an annuity, you don't have enough wealth, you can extract home equity using the reverse mortgage, and you use that to purchase an annuity. And so that sort of doubles the optimal demand in that model. So more work on that needs to be done. Okay, so I'll stop here. And happy to take questions and hear from Glenn, of course.
Okay, thank you very much. Pleasure to be here. A pleasure to be discussing this paper. There's a lot here. We could start with equation 1 and then go to equation 2, but let's not do that. I've got limited time. Very, very rich models. So what I want to do is talk about some of the general issues in using models and then some of the very specific things in this model. First question is we need to draw a distinction, and I sort of realized this between academic and policy lives of models and modelers. In my case, I've spent about 40 years building large-scale models for the World Bank in trade policy, for the Swedish government in carbon tax policy, for the Danish government, where Stefan got involved, for the government in tax policy initially, and shopping hour policy, which is actually our one big impact in that group, and for tobacco litigation for the United States and for Canada, so for plaintiffs, and even more recently now for the Royal Commission into Aged Care Quality and Survey in Australia. It's a long-winded way of saying we were really interested in this type of model. And one of the interesting things for me in that situation is I learned a little bit about the sociology of this, because Royal Commissions are big affairs. This was budgeted at 104 million, came in at about 125 million over 4 years. A lot of research is commissioned. I was a senior advisor to the commission and evaluating these sorts of things. This is the type of model we wanted, because we had 3 or 4 years to work with people. We could talk to them, and I'll just make a general comment here. One of the things that happens with Royal Commissions is there are sharks in the waters called big general consulting firms. You know the labels of these guys. They swim around and they get $1 million price tags just like that. I'll tell you who was valuable. Every dollar spent on academics doing stuff that you could go talk to them and say, look, I didn't like that, leave it in, but can you turn it off, can you put it in, let's talk to me about the pathway. So I got a wonderful experience in those two different things. In the past, I've been the person building the model, so I couldn't if I didn't like it, I'd go change it, or my co-author would go change it. But this was exactly where you need to be able to have these things built up. And that's one of the things I think is most important about this for this institute, but also is where I'm going to start to have some questions. And that is, you need to have over several years the theoretical structure built up to be able to accommodate data as needed to look at certain issues. And then you need to start to collect bits and pieces of the data or have a survey. And that, I think, is the weakest part of this. So, in other words, there's a very strong part in putting together a very, very rich model that can answer a lot of questions. I'm going to pose a couple that I'd love to see it do. That's not to criticize what you've done. And I'd love to see the welfare calculations at the end, but that's doable. You just decided not to focus on them. That's what's really beautiful here. And then make some suggestions about how you collect data to calibrate this hydra-headed monster, because that's always a good question. So let's get into the comments. First referee tip, and I do this, I now referee a lot of stuff in behavioural finance, is flip to the back and see if you've got a lot of structural theory ending up in an ordinary least squares progression. And, you guys passed that bar. Conditional on theta, this is their set of parameters, it's OLS, but the non-linear, it is least squares, that's not the issue. The non-linear part is where the real work is being done here. So it does pass that bar. Usually when I'm refereeing, if this thing ends up being OLS and then they write the results up, I really don't give a stuff about what they claim about theory. They don't care either. There are indeed people, I have a colleague in one of my departments that does that. He actually writes theoretical stuff, and these are in good journals, management science, finance journals, theoretical stuff. And then the data's brought in and it's just OLS at the end. And it's just puffery, signifying nothing. So we need to be sensitive about that, but this one does pass that. Second thing is, there is a bit of a witch's brew of behavioural slogans here, and I want to talk about that. I'm not unhappy with those, even if I'm unhappy with the particular specification, because I'm thinking now of someone who might commission this work and use it for policy. I can ask, can you please turn that off, turn that off, turn that off, turn that off, let me understand the core mechanism, then put it back in. I might complain as an academic as to whether this has been, and I will actually, knowing me, but as whether this has been modelled correctly. But that way I get to tell the clean story with the simplest possible traditional model. If I don't understand the mechanisms in that setting, I don't have a snowflake's chance in hell of understanding them when all of these things are turned on. So that's one of the things I love about this. So most of my comments are going to be about the things that can't be easily turned off and on. Okay? Here's some of the behavioural slogans, Epstein's Zen. We'll talk a little bit about that in a moment. Decision utility and experience utility. This is one I've worked in this field for 40 years, I just don't have a clue what that means. I know the literature, that's the case where I have read the literature, I don't really understand it. Inertia, status quo biases, apparently these are the same, default bias, probabilistic take-up. I've got my preferences on how to model those, like anyone who works in the field, but as somebody commissioning serious policy research, they can be turned off and on easily. So I don't have a real issue with those. Some of the things that I thought were missing in action, but they've come up in the calibration, is the miscalibration of beliefs, particularly, in other words, thinking of that as a behavioural biases, particularly thinking about biased beliefs about longevity risks and housing prices. Longevity risk is the elephant in the room here. I mean, we all know that. and confidence. So I want to be able to distinguish biased beliefs from beliefs that are overconfident or insufficiently confident, okay? I'm not, by the way, for those of you who do finance, and I can see many in the room, there's this nonsense concept in finance called overconfidence, which is really just optimism bias. People aren't using the language correctly. So I'm not talking about overconfidence in terms of a bias, I'm talking about like precision, variance, standard deviation of the beliefs. We'll come back to that in a minute. So here's why behavioural structure matters. Actually, I have to smile. This is my Harvard moment. You know, most people have been to Harvard. You can sort of time your clock how long it is before they'll tell you they've been to Harvard. My wife is at the back of the room. She's putting a paper up. When you're commenting on someone's paper, how soon is it before I refer to my own papers? So this is the why the behavioural structure matters. In other words, this is a big, rich model, you know, because it's a big, rich question. It's a damn important question. You have to have all those subscripts and that notation and the structure in there in order to do sensible, coherent, and rigorous and understandable policy normative inferences. It directly drives the policy conclusions. And this is my Geneva lecture. I talked about this with respect to insurance and annuities. I tend to view annuities as just very specialized insurance contracts. That's unimportant. But I'm talking about all of the literature in this area, the types of assumptions, the difficulty of doing normative stuff. Behavioural welfare economics is, and this is where it's always good to quote the Greeks, so I'm quoting Homer, every time I learn something new, it pushes some old stuff out of my brain. So a lot of behavioural economics has been sort of brought into welfare economics, but we've forgotten the old-time welfare economics. That's why I love to have a model where in the end of the day I could say, give me the equivalent variation in income of this policy. I want to see take-up, I want to see pricing, the loading factors, all those things, to understand the mechanisms, to tell the story, but I want to see welfare, okay? And we can do that. Here's the core methodological challenge, and this is getting into the behavioural things, the frictions that have been added. How can we rely on revealed preferences, and I'm being, since I believe in subjective EU, or I'll also add in beliefs, I'll be like Savage. We can't rely on those because those are the things that we believe are mistaken in some sense. So how do we build our welfare statements? To the nudgers, we don't, since it's obvious what's better. They bypass this question. The non-demistas do it because they only do cost-effectiveness analysis. And by the way, here's one of my other T-shirts that I wear, which is appropriate for these sorts of things when you're talking about behavioural welfare economics. The nudgers are looking for sort of simple solutions to a problem, to complex problems, but they're just wrong. Okay, let me go back now to a core question. This is a lovely line from, anyone know? Anna Karenina, very good, very good. The cultured Australian in the back room. Here we go. It's the opening line of Tolstoy's Anna Karenina. All happy families are alike. Each unhappy family is unhappy in its own way. Let's have a little story about the additivity family. Yes, we're talking about additive atemporal utility functions and additive intertemporal utility functions. This is the point when my daughter goes to sleep usually. So we're going to talk about additivity and intertemporal utility and non-additivity and intertemporal utility here. Here's your intertemporal utility function. Here's your atemporal utility function and your atemporal, additive, all right? Let's keep these separate. This is really important. This is the one moment I've got to slow down. We can have additivity in risk preferences and additivity here. Here's your familiar canonical model, exponential discounting with EUT, right? You could stick with an additive intertemporal utility function. You can have exponential discounting with non-EUT, all right? Now, let's add in the non-additivity and intertemporal utility. By the way, this is not axiomatic. This stuff is often axiomatic in terms of our statements about risk preferences. This is just sheer bloody convenience. Paul Samuel, it's just a pure convenience. Let's add in some non-additivity. If you have EUT, you've got either a Krebs-Porteous specification or you've got what we call correlation aversion with EUT. Actually, Larry Epstein does down in Toronto, calls it that. That's his terminology. Over here, when you've got a non-additivity in your atemporal utility and intertemporal utility thing, here's Epstein's sin, or you've got correlation aversion with non-EUT. So let's unpack these just a little bit. So this is the corner that this model is working in. Correlation aversion is very simple. This is worth doing. It's a very, very simple concept. Here's Australian notation. Little x is small and big X is big. Get it? Small and big? Yes. Okay. Little y is small and this big Y is big. This is income to be received sooner. X you get sooner and Y you get later. But where they're also, so there's two attributes. This is actually going to be multi-attribute utility at work. One attribute is the money sooner or later? The other is it small or big? Two attributes. Okay? Define a lottery, which is a 50-50 mix of a low amount set now and a big amount in the future, or a big amount now and a small amount in the future. Note what's happening here. I'm spreading the variability over time. Okay? So these are, and then define a lottery beta as these are correlated. This is what's called correlation aversion. I get a terrible outcome here and a terrible outcome here, or really good here and really good here. Now, let the person make a decision over lottery alpha and beta. If they're neutral, if they say they're different, they're correlation neutral. That means they're intertemporally risk neutral. I prefer that terminology, it's more informative. They don't care about variations over time. If they're correlation averse, they prefer to mix over time, right? Here's correlation loving. Here's why, this is the history of this. A correlation aversion is like atemporal risk aversion. Someone who is atemporally risk averse prefers non-extreme payoffs within a period between the X's or between the Y's. Correlation aversion prefers non-extreme payoffs over time. Okay, this is a familiar concept in the literature. Okay, Keeney, Richard, probably the most important paper from Meyer, and Larry Epstein, who really named correlation aversion. So it's got a long, long history of venerable history. That's not the issue. Here's why this matters. First, the moment you see an additive utility function, here's my referee tip number 2, just have a look and see if there's an additive utility function. You can make some smart and intelligent technical comment. Oh, that means you're assuming intertemporal risk neutrality, are you? And they'll say, oh, no, but they are. So that's an if and only if statement. Here's a really important point. This is what defines if you're correlation averse. Look, that's the familiar expression, but notice it's dx dy here. That means it's got nothing to do with atemporal risk aversion or atemporal risk aversion. This is important. So when someone says, here's a risk tolerance measure, scalar, what the hell is it? Is it atemporal risk aversion? Is it intertemporal risk aversion? Is it some smorgasbord of these things? You've got no clue. You can't just elicit that as a scalar. They're completely independent, which is where the independence of atemporal risk aversion and intertemporal risk aversion, which relates to the EIS, comes in. So you can separate these out. There's no necessary connection between them, all right? And we talked about the literature in this paper. Now let's get to Epstein-Zinn. Here's the thing. Correlation aversion allows you, if you've got a non-additive intertemporal utility function, and we use this as a simple CES function, we're simple folks, allows a non-additivity. Epstein-Zinn, I'll say that I've got a bunch of slides and I'm going to go through these quickly. This is just here to document what I'm saying if someone's interested. It essentially assumes a very specific class of non-EUT models. They trumpet in their paper, oh, we're non-EUT, everybody should be non-EUT these days, we're all behavioural now. Problem is, Larry, it's the one EUT model which has been immediately rejected, if you actually read the literature. What the Decumulation class of models does is it relaxes the independence axiom. You remember, if I prefer A to B, then I'll prefer A plus some probability of a common consequence C to B plus the same probability of the common consequence C. They relax the independence axiom to what's called the betweeners axiom. All that means is C has to be a mixture of A and B. It seems like a simple thing. It does this to the Marshak-Machina pictures. This illustrates a lottery in the standard parallel indifference curves of EUT. The steepness tells you how risk averse you are. Here's the Chu-Deagle model. So it's keeping straight line indifference curves, but they're not parallel, okay? So what? So what? It was killed on arrival, dead on arrival with empirical work. You can read the details here. There's a major paper by Colin Cameron. No experimental economist who reads the literature has any doubt about this issue. This has been rejected many times. Basically, the problem is you need rank-dependent utility to make these kind of wavy or have some curves to some non-linearity there. So the Chu-Deagle model bakes that in. You can't turn this off and still have the separation of risk and time preferences. So that's the problem. If you had something in the model that could be turned off, if I didn't like it, I would say, well, turn it off so I understand it, that'd be great. You can't with Epstein's Z. Here's something else. Non-additivity, folks, has been around for a long time. When I teach behavioural finance to PhD students, I remind them, you remember the equity premium puzzle? Chalcinides had a habit formation, which is just a particular type of non-additivity. Closer to home, in terms of annuities, this famous paper that we're all familiar with also had non-additivity in there. So that's the anachrene in a way. There's a whole bunch of ways to be non-additive is the point. Calibration calamities. There's many a slip, twixt, lip and cup, and basically the idea here is that there's some key steps that are just where this survey is not ready for prime time calibration. So I'm going to make a constructive suggestion in a minute. I know I'm short in time. It is survey data. I know you're using the word experiment, but let's just keep. An old professor of mine, Ed Lima, said, if you're making a strong assumption, put your hand up in the air about it, and leave it up in the air. So you don't forget that it'll start to ache after a while. You imputed missing values, by the way. You must use multiple imputation there and carry along those there. That's just sort of a given. There's some free-wheeling interpretation. I'll just focus on one of them here. Here's a survey question. Stefan, you have a look at this, mate, and tell me if we needed to run those very expensive, time-consuming experiments. I prefer to live well, but for fewer years, than to live long and have to sacrifice my quality of life. Answer between 5 and 1, like it's scale. That gives you the inverse of the elasticity of intertemporal substitution. We did a lot of work to get that. Something tells me that ain't gonna do it, baby. So I'm just saying that seems some of these others are a little bit forced as well. I'm going to say something constructive in a second on that. Then we've got this is supposed to tell us risk aversion. Now again, is that atemporal risk aversion? Is that intertemporal risk aversion? Well, let's call it the atemporal one because, I don't know why. And then we come down with these preference types. All right, let me finish up here. I'll skip on subjective beliefs because I've got a lot to say here. But if Anna Maria was here, I was going to show her this picture. But we've done this also for her Big Five, by the way. But we don't have time. Let me finish with this. What you need to do here is come out of the closet, be a proud Bayesian. No, and I'm serious about this. One of the things you want to do is you've got a lot of parameters here, lots and lots of calibrated parameters, just like the old computable general equilibrium models. We had tens of thousands of these. Here's an example looking at the marginal excess burden, paper in the AER, looking at the GEMTAP model. John Wally used to be at Western Ontario, which is where I went there, and John Chauvin. And so we actually did a study where we gave priors to the point estimates and simulated a lot. We got confidence intervals from the things that were estimated. If there was a covariance matrix, we could put that in. Otherwise, we have uniform distributions that are minimally plausible. And we did this in the Review of Economic Stats and came up with this. Basically, you turned a point estimate into a distribution. Why? Because your prior is that the point estimate is not the only value. Guess what? It comes with a standard error and a confidence interval. This is not saying, I've got 5 parameters. Let me perturb this one by itself and see what happens to the model. Let me perturb this one. That's not it. It's perturbing them all together. I don't care that it takes 22,000. It takes 6 months to write the paper anyway. Get the model to run and then just let it run a bunch of times. All right, let me finish up now. So the idea then is you can come up with lots of numerical quantification just to tell a policymaker that you think you got the sign right. And I'm talking welfare effects actually there in terms of signs, because usually the others are bounded, or the rough magnitudes. So this is one of the points that John Wally used to make. We model numerically for qualitative insights most of the time, and maybe rough magnitude. Let's be honest about that. Okay, summary. We need these models for welfare evaluation. That's why I would love to have just seen the welfare calculations at the end, because that's the whole point. Ignore the false dichotomy of the randomistas that say, you either do simple randomized controlled trials, or you have these horribly complex things to calibrate, and you have to do a lot of theory. Sorry, yes, we have to do theory to do rigorous welfare evaluation. Tough. And be careful in calibration and respect your price. So I would love to see the survey used in an appendix, to be honest, to say, here's where the survey gives us some clues where the point estimates are. We're kind of looking at a bit of literature here, and here's what we're going to assume as a distribution based on those things. So don't throw the survey out, but use it, which I think was your intent, to structure the parameters so they're realistic. In the end, be happy with qualitative insights. I want to see the welfare effects and are they positive and negative, how confident we are. And one of the things you can do here, with an exception, is run counterfactual so we can tell stories about what's driving it. I would just kill Epstein's in, I'd kill discussions of inertia, I'd kill point estimates of subjective beliefs, but that's just me. And let me leave it there. Thank you.
Thank you, Glenn. There's a few comments I was expecting. So in this literature, yeah, preferences are intertemporal and risk preferences is a debated, very debated issue. So and now we're using it Stanzine. I did estimate, I don't know if you've ever looked at preferences of Antoine Beauvigny.
Yeah. He's actually, Antoine Beauvigny is doing exactly the stuff that we're doing. He's doing slightly different.
So for now, so there's two things. So the estimates we have now, at least given the preference, the parameter configuration, they don't violate monotonicity, which is one of the criticisms of the Stanzine. So that's, but then we did re-estimate. I did not redo all of the simulations with these preferences, but at least the estimates coming out of that model and the comparative statics are similar, which is interesting. I don't know what it means, but that's something we can look at. My co-author is in the finance literature. Stanzine is the thing we should use, so we're just using it for
because it's tattooed on someone's ass.
Yeah, of course. So as I'm preparing this with the responses, we've done it 70% of the way. We'll see the reference. Then for the other comments, they're all fair, and we do need at some point these models. So the reason why we did this is that all these other papers give us a lot of insight of why is take-up so low from information friction, all sorts of other things, but we have no idea of first of all, what is the benchmark, how high should it be, and second, if we start thinking about policy, which we didn't include here, suppose the government would introduce a public scheme or something like this, what impact it would have. We can't do it with the reduced form stuff.
And interestingly, your results are suggesting that probably the welfare gains are not going to be that great in the current model.
Yeah.
Plus, I would love you to look at life care annuities, which Susan's looked at as well. That, to me, that's the big elephant in the room.
Yeah, so we have the combination of comparisons with annuities. Does not seem to bite. We don't know why, so we will investigate that. But
what we looked at, and it didn't survive through the Commission for political reasons, we can talk about some other time, is a social life care, socially funded life care annuity to augmented with private compensation. And the numbers that we were looking at made that extremely attractive. And that's got a lot to do with the inefficiency of the current aged care system in Australia in terms of funding and the inequities. So, you're replacing a very, very inequitable, unfair scheme in terms of burden. But that's a